Thank you, everybody. Good morning, and really appreciate you joining me here on the personal side of the tax planning for today. But like I said, I want to talk about the personal tax planning today. And there's been a lot of changes, not only with the Tax Cuts and Jobs Act, but also with the CARES Act. And the CARES Act, as I mentioned yesterday, that's our new stimulus program that came out in March. But when we look at the personal tax planning components here, and you just look at how much money each of us is paying in taxes every year, and the IRS has done some studies on this, so has the Tax Foundation and other groups. But in 2020, we're going to spend more on taxes than we spend on food, shelter, and clothing combined. And that's what that 3,859 number is. That's the average amount that people spend in excess, on taxes in excess of food, shelter, and clothing. So we're looking at $300 a month more than what you spend on all of this, and so many of us then don't even do any tax planning. We think, well, the tax planning is only for the really high-end people, the Bill Gateses and the Warren Buffetts of the world, but it's for all of us here. And when you stop doing tax planning or you don't start to do tax planning, you're not going to win the game. You're going to absolutely lose the game. Now, obviously, it makes a big difference, where you live here, as far as, with the state income taxes. So, for instance, I'm from Colorado. I'm right in the middle of the country as far as number 26. So, as far as the taxes go, we're pretty much average. This event was supposed to be done in Phoenix. So, you can see Arizona is a much less tax state than Colorado. But again, unless we're willing to move, not much we can do. But plan. And so here, when we're looking at how many days everybody needs to work just to pay the taxes, and just think, before COVID here, all the days you worked in January and February and March, and all the way to tax day, pretty much for most of the country, we were working for the government. And it's only after this tax day that we start making some changes, some money for ourselves. So when we're looking at the personal tax planning, in 2020, obviously a lot of business changes, itemized deductions, brackets, and whatever, but we also have to marry this to the CARES Act. And lots of different changes that have come about as a result of the CARES Act. And let's start with the economic stimulus payments. And these are the payments that we were seeing coming out. Everybody gets $1,200, married couples double that to $2,400. This is not taxable income. It's actually considered to be an advanced tax credit, but it's not taxable income. Now, the unfortunate part of this, obviously there's a lot of rules on this, and not everybody qualifies. So when you start reading, oh, everybody's going to get $1,200, that's not the case. And we're also seeing, as far as the Republican bill that is making its way through the rounds, that will also include another $1,200 check. So they are, for whatever reason, that $1,200 seems to be a, sort of a sweet spot as far as what they're looking for. But, like I said, not everybody is going to qualify for this. So now the question is, who does qualify? First of all, live in the U.S., Social Security number, pretty straightforward. You filed a return for 18 and or 19. There are ways that you can get the economic stimulus check without filing a tax return. So even though it says there you need to file a return, some taxpayers are not obligated to file a return every year. They still would qualify. So look into that as well. Be at least 18 years old and not be claimed as a dependent by the parents, okay? And so the 18-year-olds comes in. There's also a $500 payment that can come in to any dependent children age 16 and under. And so it's very possible then that you can get the $1,200, maybe $2,400, plus another $500 check. Again, this is not taxable income. So, you get a $500 check or the $1,200, or maybe you get them both and you get $1,700. None of that is taxable income to you. So you don't have to worry about having to report that when you do your next tax return, the 2020 return. All right, number 4 here, don't make too much money. And so the single taxpayers with adjusted gross income of less than $75,000, and then you can double that for married taxpayers who file a joint return, that is going to be our income threshold. So you make less than $75,000, and again, that's adjusted gross income. That's not taxable income. So this is before your standard deduction or before your itemized deductions if you itemize. So anyways, as long as we make less than this, we're good to go. What happens though if we make more than this? And making more than this, so meaning that I'm single and I make more than 75,000, as long as I make less than 99,000, I'm going to get some check. So if I'm making 76,000 or 80,000, I'm not going to receive 1,200, but it's going to be more than 0. And again, we double that for married couples filing joint. But there are going to be some strategies here that I'll get into as to what we can do. But here's how the reduction plays out. And I just wanted to put this slide in here so you can figure it out. So if I make $75,000 a year, I'm going to get the $1,200 check. Let's say I make $75,100. That check is now going to be reduced by $5, as this slide shows. So again, not a great amount, but once you get up to the 99,000, your check is down to 0. So again, that's we want to take a look at, see if there's any ways around this, or if there's any planning opportunities. Maybe you can look at the amount of money that you're going to be making in certain years, including 2020. And that's going to be one of our wild cards here, because for a lot of individuals in the United States, including a lot of us business owners, we are in a position where our income is going down. Maybe our business was shut down for 3 months, or maybe it's just it's still open, but we're not making the amount of money that we were making before. So there are some planning opportunities here with 2020, and I'll show you how that plays out as far as being able to claim the advance credit on your tax return if you don't get it in advance. So example 1 here, we have a married couple file a joint return, and they have 2 children, 2 young children. So both of them obviously underage, or they're 16 and under, I guess, under 17, however you want to look at it. And this couple has an adjusted gross income less than the phase out amount for a married couple. So in this case, each of the parents is going to qualify for a $1,200 check, and each of the children will qualify for a $500 check. So this family is going to take in $3,400 from the first stimulus round, and again, not pay any tax on the $3,400. And there's a couple different ways you can get this. So if we look at this particular example, we have a single gentleman. So Jose's single, makes his $75,000 per year, and has his W-2, so he has 10 grand withheld. He receives his $1,200 stimulus check. So let's say he received that in April, cashed it, whatever. He goes to file his 2020 tax return here. You can see that 1, he's not being taxed on the $1,200, but 2, he's not going to get any benefit of the $1,200 because he already received it. The question now becomes, what if he didn't receive it? So maybe his income was higher in one of the previous years, or maybe he didn't file a return, or whatever. Somehow he missed the payment. Maybe the government didn't get it to him. So even though he didn't physically receive the check, he is going to have the opportunity to claim the credit on the tax return. So we go back to the prior slide. Jose received a $438 refund. On this slide, it jumps up to $1,638 because we've given him the credit that he didn't receive. So one way or the other, if you're supposed to get this credit, you're either going to get it in advance in the form of a check or a prepaid debit card or something along those lines. But if you don't do that, you can get the credit on the return. And again, as you see here, it's a refundable tax credit. So we're in pretty good shape there as far as getting the money. Now, obviously, I'd advise Jose, hey, let's get the money as soon as possible. Let's not wait until April of 2021 before we get the $1,200. But we're going to see a lot of instances where folks didn't get the $1,200 in advance, and therefore they'll be able to claim the credit. So, looking at who qualifies, I guess the flip side of that is who doesn't qualify. And obviously on the money side, you make more than the thresholds, which I mentioned, you're out. You don't have a social, you're out. If you owe back child support, you're out as far as getting the money. The custody issues here, basically as far as the $500 payment goes, if we have a divorce situation and the parents split the custody and they take turns, basically one claims them in 19, one in 20, whoever claims the child in 19 is going to get the $500 check. So we don't typically like having to rely on luck as far as taxes go, but this is one of those instances where if you are in a divorce situation, obviously makes a difference on who took the dependent in 2019. College students also do not qualify because if you're claimed as a dependent or you could be claimed, you're not eligible. And for some reason, the 17-year-olds got excluded. So if you're 18 and over, you can qualify for the payment if you're not a dependent. And if you're 16 and under, the parents can get the $500 check. The 17-year-olds, for whatever reason, get shut out. They don't get the $500 check to the parents, and they're also not eligible for the $1,200 stimulus payment. Disabled adults and senior citizens, if they're claimed as a dependent on someone else's return. So again, if you're a senior and let's say that your son or daughter is caring for you, or a disabled adult, that's going to depend there on whether you're claimed or not. Babies born in 2020, you're not going to get the credit until the return is filed next year, but don't miss out on that. You've got a $500 tax credit, and again, difference between a tax credit and a tax deduction is that a tax deduction is only worth what your tax bracket is. So if I'm in the 35% tax bracket, every $100 that I'm able to deduct, I can get a $35 tax benefit. If it's a tax credit, that same $100 credit will reduce my taxes dollar for dollar. So obviously we want the tax credit, not the deduction, but make sure that we get that if you have a child that's born in 2020. The question that I had at the beginning of this is there's all these different moving parts. We've got income from 18, we've got income from 19, and we've got our 2020 income that is going to be reported sometime in 21. What happens if there's income changes? So I qualify for the stimulus in 1 year, but I wouldn't qualify it for the next year. And so this is what this slide is showing. So I'm a single individual. Let's say I made $50,000 in 2018, and so I get the $1,200 stimulus check. In 19, I earn more than the phase out. So that $99,000 amount, I earn more than that. I am not required to pay the stimulus check back. Okay, even though I would not have qualified for it in 19, I did qualify for it based on 18's income, okay, the adjusted gross income. So again, we're not required to pay this back. Look at another situation here where we flip the years around. In 18, I don't qualify. In 19, I do qualify. We can now get the full stimulus check as a refundable credit on our 2020 return. Now, the reason that they may do it this way is because you didn't qualify in 18. That's what the IRS was basing it on. So when you file the 2020 return, you will get the credit at that point. And again, I think it's important to make sure that just like with the business returns, you're working with a preparer that understands these new tax laws, because we're not going to have any court cases. We're probably not going to have any guidance from the IRS before we need to file our 2020 tax returns, given that all of this stuff is so new. So you're going to have a preparer that is going to be able to work with you, take your situation, and try to produce the best tax situation that you can. And so, like I've mentioned many times in the past with business returns, make sure that your return preparer does the type of returns that you're doing. For instance, if you have 5 rental properties and you have 5 different LLCs, make sure that your return preparer does the real estate transactions and the real estate tax reporting on a very regular basis. Because somebody like myself, let's say, who invests in the stock market and who invests in real estate, I would be very, very competent, even though I don't prepare returns anymore, but I would be very competent at preparing any of those types of returns. But if you want to get into a lot of tax planning for foreign, Canada and the US, if you want to get into some publicly traded companies, which I've never worked with, I would have a major problem. So the competence, I think, comes from what is it that the return preparer specializes in, and make sure that she or he specializes in what you're doing. And on the personal side, let's make sure that they really understand this CARES Act. I've put in here, as far as, I'm not going to go over this, but if you want to know what the IRS is saying about the repayment, here's their answer, so that if you're wondering that I'm just making this up, I'm not. This is the IRS from the IRS website. And they do have a pretty good website, I mean, a very good website in general, but a pretty good website on the CARES Act. So I did go through that, and I've been back and forth to that several times, because obviously the stuff is changing quite a bit. But I would recommend that if you're not sure about what you're supposed to do with a payment or taxability or whatever, and you don't want to call your CPA, you don't want to get charged for it or whatever, go to the IRS website. I think you'll like what you see there. Other examples of how this works out. So in 2018, Caitlin's claimed as a dependent on a return. So you can see she receives no payment here. And presumably she's also over age 16, so the parents are not going to get the $500 child credit there. In 19, she graduates, locates a job, no longer a dependent, and is making less than the threshold. So in 18, she gets no payment. 19, she does. And again, she may have to claim that as a credit on her 2020 return, but it's a timing issue. At some point here, Caitlin's going to get the $1,200. Let's look at another example here where we have a married couple, no children, making quote unquote too much money. So you see in 18, they get nothing. But in 19, here the wife takes a leave of absence, and they give birth to their first child, and their adjusted gross income vastly decreases. So in 2019, they're going to be able to get this $2,900 credit, $1,200 for each of them, plus another $500 for the new baby that was born in 19. So again, this is a year by year type situation as far as, do you qualify or do you not? Another example here, we have a married couple, 16-year-old son in 18, and then in 19. And the difference here, even though their income is identical in both years, is that the 16-year-old in 18 will qualify for the $500, whereas in 19, it won't, because Andy's now 17 years old and now doesn't qualify for the $500. So in this case, if you haven't filed 19 yet, and I think a lot of us on this that are attending this event, including myself, maybe haven't even filed 19 yet. So I can't file it until I get a couple K1s that I'm still waiting on. So maybe I delay filing here, get my $2,900 payment, and then I go ahead and file if I want to get that money up front. So again, planning comes in on the CARES Act. It's something that we're certainly going to want to take a look at and plan for. Okay, a couple of other changes here. Larger standard deduction. So this is for those that are going to decide, do we need to itemize or do we need to take the standard deduction? Got a little bit of a bump up this year. So if I'm single, $12,400 is my standard deduction. So if I add up all my mortgage interest, and maybe in this case I'm renting, any income tax, property taxes that I'm paying, state taxes, what have you, and it's less than that $12,400, I take the standard deduction. If it's more than that, then I can itemize. And so we're seeing now pretty much about 70 to 80% of the taxpayers are taking the standard deduction. And if you are one of those, a little change here, but every change helps, is that the standard deduction does not permit you to itemize anything, including charitable contributions. And the CARES Act changed that. So now we can itemize, or excuse me, we can now claim the standard deduction of $12,400, or double that if you're married, and add $300 to that as far as a charitable contribution, as long as you really did make an extra $300 of cash donations. Married couples can double that, so I did look this up because it's very difficult to find it actually, but it was buried that on the IRS website that married couples do get $600, but I didn't see that anywhere in the frequently asked questions or whatever on the IRS website. So again, not a whole lot of money, but if you're going to itemize and maybe you are making some charitable donations this year and you can back up the 300 or 600 or 200 or whatever the number happens to be, might as well claim it and get your tax benefits here. The other big change here, and this is a huge planning opportunity for people who were looking at or considering making charitable donations. So if we do itemize our deductions on a Schedule A, and we've mortgaged the mortgage interest, the taxes, the charity, these types of deductions, in the past, and this was going to be true for 2019, 2020, 2018, this was all the limitations that were put in, the charitable deductions and the donations could not exceed 60% of your adjusted gross income. So if we look in 2019 and my AGI was 100,000, and let's say I gave 100,000 to charity, I would only be able to deduct 60,000 because that's 60% of my income, and the other 40,000 that I gave to charity would be carried forward for 5 years, and I could use it up that way. In 2020, and this is only for this year, it's not for 19 or 18 or any of the prior years, the 60% limitation is gone. Okay, there is no limitation on this. So here is a nice planning opportunity that we can effectively zero out our entire tax liability in 2020 by making a charitable contribution. So in this hypothetical case, I have an AGI of a couple 100,000 here. I've got my mortgage interest, state taxes, and then I add it up to the charitable donations. And remember, in the past, if I had donated 175,000, I would only be able to claim 60% of that. So you could see that the tax on the other 40% would have been that $7,890. And under this rule here, I can zero out my tax liability. I have had a couple people ask when I've shown this slide on webinars before about the cap on the mortgage interest, and don't confuse the state tax cap with a cap on the mortgage interest. So your state taxes are capped at $10,000 per year, but your mortgage interest is not, and so that number can be considerably higher based on the amount of the mortgage. And so let's keep that in focus as well. Okay, so as far as other changes go, again, personal exemptions have been eliminated. The CARES Act did not change that at all. I mentioned the property taxes. This is called the SALT rule, S-A-L-T, and it's state and local tax, S-A-L-T. That is capped at 10 grand a year. We can't deduct foreign property taxes any longer. So let's say you had a ski condo at Whistler up in Canada. In the past, you would be able to deduct that, no longer here. Home office deduction may become more valuable. And the reason I put this in here is because let's say that our taxes on our house were $10,000 a year and 20% of our house is our office. In that situation, then we would only report $8,000 on our Schedule A as property taxes, and then we can have another $2,000 of other taxes to get to the $10,000 cap, and then the other $2,000 would be reported on the home office. So if you look at this, I mean, very big difference between the 2 years. In 2017, I had 25,000 of total taxes, state taxes, whatever. In 18 and 19, I had the exact same number, but in 17, I could claim the full amount. in 18, 19, and 20, I'm capped. There is legislation from the Democratic Party on eliminating this cap, but right now they have not been able to reach an agreement with the Republican Party for whatever reason. And so we may see this cap come about as a result of CARES Act 2 or 3 or whatever, whatever we see in the future. Remember, though, that when you don't like a tax law, you don't like this tax rule, I don't like the fact that I'm capped at $10,000. The cap does not apply to any taxes paid in a trade or business or that are connected with a rental activity. So if let's say that my personal taxes, let's say that I'm paying $25,000 a year between income tax and property taxes, I'm cut down to $10,000. Let's say now that I have 10 rental properties and each of those pays $10,000 a year in taxes. So I have this $100,000 of property taxes. Every penny of that is tax deductible. And I can also deduct my $10,000. Same with a trade or business. Let's say that I have a warehouse and I'm paying $20,000 in property taxes on that building. All of those property taxes are deductible against the business income. So again, when you don't like a tax rule, we need to look at the loopholes. How can we get around the tax law? So, if you go into your preparer and say, can I deduct this? And the answer is no. Your next question should be, why not? Or how can I? Is there a way around this rule? So if you look at the IRS and we ask the IRS, can I deduct my moving expenses? The answer is no. Can I deduct my union dues? No. Can I deduct investment expenses? No. All of these are no's. And if you just take that answer and move on, you will miss out on the loopholes. And the loopholes over there on the right, in that sort of light purplish color, show that moving expenses are not deductible for a person, for an individual. On your personal return, you can't deduct it. But what if you move your business? That is deductible. If you say, well, investment expenses, are different expenses that I have, let's say some trade journals or maybe some education related expenses. For an investor, those are not tax deductible. But for a stock market trader, a lot of the stuff that Mike does, and Mike was talking about yesterday, these expenses become deductible because you're no longer an investor, but you're a trader. You're in business of stock trading. And you look at the other ones here, the tools, uniforms, all of that stuff. If you're in business, this all becomes tax deductible. So if we look at, the situation of, can I deduct the cost of preparing my tax return? And the answer to that is no as a person, but yes as a business owner. So you can have your tax return preparer. Let's say your return preparer charges you $500 to do the return. And let's say you have one rental property on there. You could be charged $100 for the personal, $400 for the rental, and the $100 you paid for the personal, not deductible. But the $400 you paid for the rental is deductible. So again, the loopholes, and this is where you get into the maybe and it depends. Is it deductible? Maybe. Is it, it depends on who is paying the expense. If it's an individual, no luck. If it's a business, you've got some luck. Same thing here, casualty theft losses, work-related education. Both of those are eliminated for individuals, but not for business owners. So when I take continuing legal education, if I'm an employee of somebody's law firm and they don't pay for it, so I have to pay for it out of my own pocket, not tax deductible. If I have a law firm and I pay the same expense, it is tax deductible. So again, maybe not logical, but we're talking taxes, not logic. Okay, so just unfortunately, we don't get that break in taxes. So let's take a look now at some of the tax avoidance strategies. And notice that this is not tax evasion. A tax evasion is a crime. Tax avoidance is tax planning. And that's obviously what we're going to be looking to do. So for the average person, for all of us on this call today and attending this event, all of this comes into play. Real estate tax planning, anybody who has rental properties, anybody who's flipping properties, you're doing some development, anything you're doing in real estate has to be planned. And in my opinion, when you start looking at real estate, to me, it is one of the best investments from a tax perspective. Forget the investment of you buy a place for 100,000, is it going up or down in value? Do you have rental income? Do you have to evict people? Forget all the issues of cash flow and everything else. But from a strictly tax perspective, real estate has a huge amount of bang for the buck. Capital gains versus ordinary income. Capital gains always taxed, especially at long-term rates, tax less than ordinary income to encourage investment. Oil and gas investments, retirement planning strategies, being able to sell our personal residence and exclude up to $250,000 or double that if we're married. All of that comes into play with the planning. And it's possible that you could in fact have a personal residence, sell it, move into a rental property, live there 2 years, and sell it and take the exclusion again. And you can do that every 2 years if you had the houses and the ability to do it. But tax-wise, there's no reason you can't. Now, I've highlighted the inheritance versus gift. And I've never done estate planning. I look at the tax issues with it, but I've never been one. I send my anybody that wants wills or estate planning stuff. I just send them over to Clint and Anderson and let them take care of it because they do a great job with it. But from a tax perspective, inheritance versus gift is huge, and it's going to become, I think, even bigger in the future, depending on what happens in the next election. So one of the ideas that's being floated out there by Mr. Biden's campaign is to eliminate the eliminate the estate tax and make it an inheritance tax. So today, if you inherit property, you inherit that tax free, whereas the estate tax is paid by the person who passes away. And so we have to really look at this inheritance versus gift versus being able to receive the money at a certain particular time. So it's a timing issue here as to how this is going to play out. The gifting can play out well, and I'll show this in a minute as far as how we can work this, but basically the gifting is going to get money out of your taxable estate. And we also have to play that with whatever changes are going to come about and the difference between an inheritance versus gift under current law. So under current law, let's say that I give somebody $15,000 worth of stock and I had paid $5,000 for that. If that person sells it, they step into my shoes with my basis. So their basis is $5,000, they sell it for 15, they're going to pay capital gains on the 10,000. Now that may be a good plan because I may be able to gift that into, let's say, one of my children, and at that point they can pay the tax or not pay it at whatever their lower rate is. But the gifting versus the inheritance here, had I died with that same $5,000 stock that is now worth 15,000, whoever inherits that receives a step up in basis. And so they would receive it for 15,000, sell it for 15,000, and nobody pays tax. So again, we're going to have to watch this component really carefully to be able to decide, let's say at the end of the year in December, do we want to make any gifts? Do we want to make a taxable gift? Perhaps we would give something in excess of 15,000. And how is this going to play out if the entire estate tax area is now replaced with an inheritance tax? So a lot of big differences here, and obviously the election will go a long ways to determine where this is going to be going in 21 and in future years. Use of business entities for tax avoidance. Do you want the income taxed at the corporate level, in which case we would use the C Corp, or do we want to let it flow through to our personal return? And obviously there's different tax rates with the different business entities depending on how you set it up. So you can set up an LLC to be taxed as a C Corp, and that'll have a flat 21% rate. Or you can have that LLC taxed as an S Corp, a partnership, disregarded, whatever, and then it'll flow through to the tax bracket of the owner of that entity. So again, planning with the business entities clearly affects the taxes paid at the personal level. Shifting income to lower brackets, if we can pull that off, obviously we're taxing the same income at a lower rate. Installment sales, so this is going to be your owner carry typically in a real estate transaction. These installment sales are taxed in the year that the money is received. So rather than receiving $100,000 this year and taxing it all, maybe you take a 10-year note and we tax $10,000 each year for the next 10 years. The caveat here that I want to make is that on installment sales, the money is taxed in the future at whatever the rate is in the future. So you don't lock in 2020 tax rates if you do an installment sale this year. So that's something that everybody needs to consider, I think, because how many people think, I guess, if I was doing this in a live, Marriott conference room or something, I would ask how many people here think that taxes are going down in the future. And as you can probably imagine, there are few, if any, hands that go up. But when I flip that question and say how many people expect tax rates to go up in the future, nearly everybody raises their hand. And I'm in that bracket too, as far as I think that the taxes are going to go up as well. So you have to take that into consideration of, do you want to pay the taxes today or do you want to pay the taxes later? And if you pay the taxes later, what's your bracket going to be? In other words, are you going to be making more or less money? And then also, if you're making more money, what's the tax rate on that additional money? Tax credits, we've already talked about. I'm going to talk about rental real estate. Business tax deductions, obviously, are going to bring down your tax bill. And then the stock trader status. And this is a real big one because a lot of folks that are using Mike's program and whatever are doing a lot of short-term trades. So, when I joined in yesterday, Mike was discussing covered calls. Those trades are going to be on a short-term basis. I may do a covered call on Microsoft today, and that trade is going to be over with in 30 days, let's say, if I do a 30-day call option. If I do enough of these, and this becomes now a business rather than an investment, and one of the things you look at is the short-term trading and how many trades you're doing. But now all of the expenses related to your stock trading business become tax deductible. And again, this is an area where a lot of taxpayers miss out because they think, well, the IRS says investment expenses are not tax deductible. And that's true. They're not tax deductible if you're an investor. But if you're a trader, they are. And so in this case, yeah, we may be dealing with semantics and an investor, a trader, you're both doing stock stuff, who cares? Well, it makes a huge difference at the tax level, whether you can deduct your expenses or not. All right, a couple of other changes that were made. Section 529 plans, this is sort of your IRA for college expenses. This has been expanded to include now kindergarten through 12 at any school, public, private, religious, doesn't really make any difference where it is. We can use these 529 plans to be able to pay expenses and not have to pay the taxes. Now, some of these expenses, if they're being used for elementary school or something under college, I guess, they could be taxable at the state level. So you want to make sure that before you use these plans for, let's say, a fifth grader, that even though the IRS isn't going to tax it, that your state won't tax it as well. So you can go to the 529 plans. There's a couple of websites out there that will list all the states and whether they follow the IRS rule or whether they don't. And if they don't, what is the tax hit going to be? And you can sort of do the math problem, figure out what you're doing. Capital gains and dividends. The highlighted part is not a typo here. That 0% tax rate does apply up to this $80,000 of income if they're married, or $40,000 if you're single. So if we look at something where, let's say that in 2020, I was laid off and I don't have a job, and maybe I make $25,000 this year between what I made in the first quarter and unemployment and whatever else. But that $25,000 would mean that, let's say that my parents in this case gifted me a stock that I sold and I had a $10,000 capital gain. In this instance, I would pay nothing in tax, whereas my parents on that same $10,000 gain may pay the 20% rate plus the 3.8% that American Care Act, or what's called the Obamacare, right, as we know it, tax comes into play. So in this case, we're doing some family tax planning by saying, if mom and dad sell this stock, they're going to pay $2,380 in tax on the $10,000 capital gain. Whereas if we gift that over to somebody in a very low tax bracket, the family now will pay nothing. And so not only do we want to look at tax planning between the business entity and the owners and then do individual planning with that, but we also want to look at intra-family planning, and is there a way that income can be legally shifted from myself, let's say as a parent, down to my children, or perhaps up to my parents, in the sense of we may have a lot of different income issues. So again, don't forget to look at the potential of planning within our family. All right, a couple things now as far as being able to get through some of the planning here and reduce our overall tax burden. I mentioned the gifting strategies, $15,000 per person per year. What we're talking about here, and there seems to be a lot of confusion on this issue, is that if you give a gift of $15K or less, it does not need to be reported anywhere. But that does not mean that you can't give a gift in excess of this. So let's say that you want to give a gift of $115,000 to one person. What that would require is a gift tax return. And so in that case, there would be $100,000 of excess gifts, in excess of $15K in this instance, and we would have to file a gift tax return. The person who made the gift files the return. But that's going to come off the estate tax exclusion. So don't think that if you give a larger gift than $15,000 that it automatically generates a tax liability. It does not. But again, this is an income shifting opportunity. We can do this with cash. We can do this with perhaps giving any sort of gifts, capital gain type issues, and what have you. When we do this, though, with the planning, if we have minor children involved, we have to look at a kiddie tax. And what happens here is that the kiddie tax prevents a parent from, let's say, a very wealthy person from putting in $1 million into a child's account, have that child pick up 100K of income or whatever the investment income is, and pay tax at a much lower rate than the millionaire parents. And so understand that there's planning that comes into play on this. If you're going to gift or if you're going to have investment income, I guess, as a result of the gifts from, over this $2,200. So anyways, applies to anybody that's under 19, so 18 and under, or if they're 19 through 23 and they're full-time students, okay, and they're not paying their own way. So in other words, parents are paying more than half of their support, the kiddie tax applies. If we have a 19-year-old who goes out and starts working, then of course we don't have this kiddie tax, and you can still use the gifting strategies there. So again, don't think that if the gifting strategies only work for a minor child. No, they can work for those that are over 18. Just depends on exactly what they're doing. Paying your children as well is a real nice tax strategy. But remember, and this doesn't apply just to the children, this applies to any employee that you have. Any employee, the pay that you give, the compensation has to be reasonable, okay, quote unquote, reasonable. So we're looking at the time, age, abilities, effort, what's involved in this job. But let's say that it's something where, I've gone back and there's been cases where we've had a 6-year-old and the tax court has approved that as an employee. Now, we're probably not paying the 6-year-old $12,000 a year. But what the IRS argued is that based on their age, effort, and abilities, the 6-year-old couldn't do the job. And so what the court looked at is, well, what's the job? And the job was to it was a mobile home park, And the 6-year-old would go around every day or on the weekends or whenever it was and pick up garbage and just basically tidy up things, clean up things. And the court said, well, why can't the 6-year-old do that? And of course, the 6-year-old was doing that. And so the IRS lost that case. But the reasonableness comes into play in a lot of different corporate situations as well. So there might be a situation where I want to pay myself a real small salary or a real big one, and I still have to make sure that that's quote unquote reasonable. But you can see here with this example here, and I've got the 15 and the 17-year-old. You know, the 15-year-old here is working 15 hours a week, making $10 an hour, and working 40 hours a year, or excuse me, 40 weeks a year. Now, I put that in there. You can obviously, they could work 40 hours a week during the summer or whatever, but just to show you kind of some examples of how this can play out. Now, a couple things to keep in mind. You must document this. So I would use time slips or some way that we can prove that this person really did work 600 hours during the year. Once we can prove that, the only other thing we have to prove is that $10 an hour was a reasonable wage, or for the 17-year-old, $12 an hour. And so once we can prove that the work was really done for the business and the hourly rate or the salary or whatever it is reasonable, then in this case, both of the children are going to file tax returns, but they don't have to pay any tax. And depending on what the parents' bracket is, you can see that the family can be saving $4,300 to $6,300 in tax just simply by hiring their children to work in the business. So again, something to consider as far as the business goes, and to be able to take appropriate planning and deductions to maximize the tax strategy, right? Minimize the taxes due. The very last bullet point here, I can't say the word plan enough. You know, you plan. You have to do tax planning. And that applies to everybody on this call. Everybody that is at this event for the last couple days here, tax planning applies to you. If you have a business, if you have rental properties, if you have income coming in, why do you want to overpay your taxes?